Jay McAndrew, thank you very much for coming here and returning to Think Tank Exchange for an interesting discussion, I believe. We do appreciate Columbia Threadneedle and the support that you give the ETF think tank. And like you were saying, it is mutually beneficial. And that's what a think tank is about. I think people forget that. But we'll have a lot of back and forth today. But for those who don't know you, tell us a little bit about yourself and Columbia Threadneedle.
Sure. I've been fortunate to work for Columbia Threadneedle for close to 8 years. I got to Columbia Threadneedle because they acquired a boutique ETF provider that we had started with a number of old wealth management alumni from a firm that you and I had worked at in the past. And I'm happy with my background because I've been able to experience wealth management and asset management, and I've been able to experience sort of startup company as well as working for Columbia Threadneedle. Columbia Threadneedle today is one of the largest asset managers in the country. We manage about $650 billion, and we're just trying to evolve our business as most businesses evolve, with trying to roll out different structures, different pricing plans to be able to meet more investors at more price points and packaging preferences than we had in the past. And we're starting to have some real success on our ETF front. So I'm happy that we'll be able to get into that and share not only that success, but why advisors are supporting our solutions and just share some of the insights and what I've learned from those conversations. So hopefully it's relevant to our listeners today. We'll try and make it that way.
Yeah, but you and I go back to your Sanford Bernstein days, right? Or thereabouts, I guess.
Well, yes, that was, I had worked at AllianceBernstein for a few years, but prior to that, we used to work at UBS together. So I remember covering you in the New York City 200 Park office. That is way down memory lane, and that is a tough time machine to probably a place that I don't quite remember that well, but yes.
Well, that's an interesting tidbit. So along those lines, we're going to have a great discussion, I think, in the beginning, just about emerging markets. And let me share my screen, because I think one of the things that a lot of people forget about is that depending on how you do your emerging markets, you've gotten a different experience, right? And in the way of, let me see here, in the way of emerging markets, if you, as you said, isolated your hold on, I'm just struggling here. If you isolated your China exposure, you had a different outcome. So while I play with my screen here, talk a little bit about what that means to isolate your China exposure.
Sure. And the reason I have a little bit of experience and maybe credibility on that topic is we had rolled out the first emerging markets ex-China ETF back in 2015. And we did that, Dan, because of really listening to investors and investors' concern about being able to express their point of view. So if I were to put you in the DeLorean and take you back 10 years, the conversation in the mid-2010s revolved around China's weight in the MSCI EM index dramatically increasing. So just to put some numbers on that, if you were to look at the mid-2010s, China went from about 18% exposure in the MSCI EM index to a high of 43% in early 2020s, just because of two reasons. Number one, MSCI as an index provider was adding new share classes like A shares into their index. So you were getting new constituents in. And then, as we know, China also had a strong market run for a number of years. But it was this concept of more than doubling from 18 to 43% that had some RIAs really asking, do they want the China tail wagging the EM dog? And they came to us and they said, would you be able to build an emerging markets ex-China, real simple portfolio, just market cap weighted, not smart beta, just EM ex-China? And we said, yes, right? You always want to listen to what your clients want and then be able to provide it. And it's not a new movie. It is certainly a movie that we've seen in the past. I know that many of the listeners are probably familiar with AAXJ, or Asia X Japan. And Asia X Japan was just created because Japan got to be too much of a concentration in Asian indices in the 80s and 90s, again, with strong market performance. And investors felt that too much Japan was crowding out exposure to the other and smaller countries. And so this is just, emerging markets ex-China, ex-CEM is just a natural evolution of investor preference, specifically in emerging markets. So, we're excited to say that emerging markets ex-China is our fastest growing ETF last year and is off to a very strong start this year. And we can certainly get into the reasons why, but ex-CEM, and it's appropriately priced at 16 basis points, so very cost effective.
And where I was fumbling was EEM was like the benchmark for years, right, in terms of funds. And then I always think it's shocking to me that IEMG and EEM, have $150 billion of capital invested in them. And yet, candidly, the performance has been disappointing, especially to your point, against those funds that have been more targeted. What do you think investors are missing in their, 75 or $150 billion of allocation?
Well, I think for a long time, and we have to remember some of the behavioral aspects of investing, you can get anchored to a good story. And I think for a long time, China was that story. But there's been some evolutions. Number one, in investor perception, right? So the number of U.S. investors that believe China was an enemy 5 years ago was 40%. Today, when U.S. Registered voters are surveyed, about 80% of those constituents feel that China is an enemy. So just the view on China and, investors' desire to own shares in the United States' largest and increasingly aggressive adversary, that's changed just in 5 years. That's number one. And so we've had a lot of conversations around investors wanting to express a more patriotic point of view in not owning China. But what most investors are critically concerned with is performance. And when you start to bifurcate and dissect emerging market attribution, what you find is that an emerging markets ex-China portfolio, on average over the last 5 years, has returned a little over 7%. A broad emerging markets approach has returned about 3.5%. So you've gotten double the performance just by leaving out China and Hong Kong. And then if you were to just try and isolate what I would call China beta, and I'm not going to name a specific product, but I want you to think about traditional China beta that makes up a majority of traditional benchmarks. And we know that there tends to be a lot of state-owned enterprises, which are not the most optimally run businesses. That's been a drag. So if you look at China beta, it's actually been negative over the last 5 years. And the other important thing is volatility, right? Because you ultimately want to understand what the sharper contribution is. So both a broad emerging markets, so MSCI EM, and an emerging markets ex-China approach that we have had about a 16% standard deviation over the last 5 years. China beta has actually had a 23% standard deviation. So said another way, Dan, in the more recent time period, China beta has been a drag on performance and has also enhanced volatility. And I just also want to be very clear. I started by saying Columbia Threadneedle was a very large asset manager. We own a lot of China. And all XCEM is a tool for investors to be able to express their own point of view on whether they want to own a lot of China, no China, state-owned enterprise China, A-share China. is just a tool to create a core to allow them to express their point of view on how much and the type of China that they want.
I think that's so important on a lot of different levels. I think it's very difficult for me to ignore China, what's happening in China, positive or negative, right? Mm-hmm. We have to think of ourselves as global investors, and just ignoring what's happening in China basically assumes that we're investors in an isolated world. And that's just not reality, right? So, sizing your risk in China or in any country can add a lot of alpha, and that's your point. And I bring that up because, now going back to 2012, as somebody who's been in these markets for a long time, I remember when IEMG was launched to basically cannibalize EEM, and I've got this chart up right here that highlights the share count on IEMG versus EEM, and actually doesn't even show how much EEM has gone down. And fee matters. Don't get me wrong. And here's another one that highlights that same thing, but in this case, VWO is the top, and then IEMG is this one. And just EEM has now gone to about 18 billion in assets versus the other two, each at 75 billion. But by the way, to your point, XEM is also priced reasonably.
Yeah, we made some changes over the years as we tried to create different accelerants within our business. And I don't know how many years ago, but we lowered the fee down to 16 basis points. And that certainly helps, right? And we're very clear that we haven't put a lot of Columbia Threadneedle insight into this. This was a product that was actually rolled out prior to, the firm I had worked at being acquired by Columbia Threadneedle. But we certainly feel like it helps conversation. So it's attractively priced. The performance has been good. And Dan, I just wanted to share one other point that has been an increasing conversation for us. And that is, if investors or financial advisors do want to own China, they want to own it in a siloed approach rather than an integrated approach. And because that siloing of China, if there is a reason or a catalyst for them to sell or get out of their China quickly, they want to be able to do it lickety-split at the push of a button and sell the silo of China, rather than have China contained, as 30 to 35% of a broad index, because then they would have to sell the integrated package to then get back into a non-integrated package. And so it's really a risk management tool for a number of the discretionary teams that I've had conversations with about knowing and understanding how much China they have and their ability to exit China as quickly and efficiently as possible when they deem that they would want to possibly do that.
And that's critical, right? That to me is portfolio management. And as I always talk about, structure matters. I had to throw that in there. So when was XCM launched?
XCM was launched September 2015.
So it's got a long history. That's the interesting part about this fund. I think people often, forget how a timeline works with a fund, and really in the last year or 2 years maybe, have you got traction with this fund? Right. Is it what's happening in China that's driving it, or is it what's happening, as an example, in India? Why are advisors now embracing it?
Well, it's a multitude of things for different reasons. So we've already touched on this concept of wanting to express a more patriotic point of view in your portfolio and not owning the U.S.'s largest and increasingly aggressive adversary. Emerging markets have not had the same sort of technology or communication services exposure of the United States. So if you've been, having a home country bias in the U.S., you really have been rewarded, right? We've been on this tremendous run of technology and growth stocks. You don't necessarily get that same concentration in emerging markets. But the conversation that we're having now is that as more forecasts are for us to have a soft landing, potentially no recession, global growth reacceleration, that's when emerging markets tend to do well. And so people over the last 18 months have said, hey, I want to rethink the way I want to get into emerging markets, and I want to have the exposure. And because they maybe haven't revisited emerging markets in hypothetically 5 or 10 years, there's now more choice for them to be able to choose solutions that better align with the opportunities that they want to see and the opportunities that they have. And I would also say that research has come along too. And I know that we've gone back and forth with some of the research that has come out on looking at emerging markets ex-China as its own and separate asset class. Many investors today would consider China to be an advanced economy, and it is an advanced economy. It's the second largest economy in the world. Before too long, it might take over the U.S. As the largest economy in the world. The only reason that it's still considered an emerging market is because generic definitions take a look at GDP per capita. And when you look at, China having 1.4, 1.5 billion people, your GDP per capita can get cut pretty low between that 2,000 to 20,000 level, per person. So that keeps it in the emerging market category. But if you look at it through any other lens, it's certainly an advanced economy. And so I think, investors having China not be in emerging markets have become much more comfortable with that idea.
Yeah. So I'm sharing my screen now, and it's highlighting XEM, how it's performed versus the other funds. And talk to us a little bit about, XEM and EMXC, because your historic performance has been very strong versus that fund as well. And it has to do with India, I'm sure, but maybe there's something more to it.
Well, it's less about India, and I know that you've shared some of the statistics about portfolio overlap. EMXC and XEM are funds that are very similar because they both take sort of a bulk market cap weighted approach to emerging markets ex-China. There are some subtle differences in the country classifications and the way that things get aggregated. But Dan, the real difference is that we've used an optimization process in running XCEM. So today we're only owning between 300 and 350 of the larger market cap names, rather than owning all 700 names that comprise sort of both the MSCI index and the index that we track, the beta thematic emerging markets ex-China index. So a lot of similarities, but we haven't owned some of the smaller names. And we think that has, allowed us to tap into bigger liquidity and just create in general less trade friction, right? Like, do you really need to own the 2 basis points of the Egyptian bank and all the trading and hassle that goes on with that? Is that going to make a meaningful difference to your portfolio? We don't think so. So as you know, all funds start small, and as they grow, it's more prudent to add more holdings. So we've been fortunate that through the growth of XCEM to operate with a fewer number of holdings, and we just think that has operationally created more efficiency for us.
Yeah, interesting. When I was also playing, because being the ETF nerd that I am, I started combining INCO with XEM and added even further alpha over before, simply because INCO has done so incredibly well. Bring us forward to that fund.
Sure.
So,
let me just clear some things for anybody who's listening. INCO, INCO is the ticker, and it is an Indian consumer ETF. We launched it, again, as part of our previous company that was focused on emerging market exposures, and it's been around since 2011. And it's just had a tremendous track record. Dan, I think, will show it over time, but the punchline or headline would be that the Indian consumer has given you the emerging market returns that you've been looking for. It's averaged over 11% a year since inception. So while many investors, Dan, as you alluded to, think that there's been a lost decade in emerging markets, the answer is there has if you've been using traditional broad-based indices for your exposure. But the Indian consumer has been far different. So I know that we might get a little bit further into INCO, but it's been around a long time, it's performed well, and it simply provides exposure to 30 companies that are either in the consumer staple sector or consumer discretionary sector, and that's it. And just to give you a little bit of background on why we introduced INCO, as an ETF provider, you want to try and stay away from Me Too type of launches where you're just rolling out something that's already been available in the marketplace, right? Then you have to compete on some small value add, or maybe it's price differential. Back in 2011, as we looked at the landscape of Indian ETFs, we found that a lot of them had concentrations in technology, and specifically in a name like Infosys. And Infosys has been a great stock. I'm sure a lot of people want to own Infosys. But the difference is that Infosys tends to generate a majority of its revenue from Europe and from the US. And as we were thinking about what exposure do we want to be able to provide to investors to tap into, trying to really target and isolate that growth of the middle class Indian consumer revenue, we wanted to do it with, consumer companies, right? So consumer discretionary and consumer staples, whether it's personal products, automobiles, two-wheel vehicles, supermarkets. So as that next level of Indian consumer starts to get more disposable income out of their paycheck, we wanted to tap into that stream. And that's exactly what INCO has done. And as you've talked about the success, and as you're demonstrating, as we've talked about on the screen, just really strong returns. So I'll stop there. A couple of other points we could add, but that's INCO.
Yeah, no, I think demographics always matter. As one who's grown up as a baby boomer, if you follow that trend, you've benefited accordingly, right? To expand a little bit further on the demographics around India.
Well, first and foremost, I would just start with touching on what we had hit on before, and that is most investors go to emerging markets to try and tap into demographics because they want to be able to scale this large population with productivity enhancements. And there's two real places to do that, right? Obviously China and India. And as investors have rethought their China exposure, my belief is that India has been the benefactor of that, right? So if you want to invest in demographics, but do it in a democracy rather than a dictatorship, you want to look to India. I think everybody's probably seen the research about the challenges that China faces with its demographics and its one-child policy really coming back to hurt them, and just the age of the population over 50 and specifically over 65. I've seen studies that say that China's population has crested and will start to decline in 2025. I've seen forecasts that China's population could be as low as 750 million people by 2100. So that's dramatic. Now, the opposite is true for India because they just tend to have a much younger population. Median age is 29 years old, rather in China being 39 years old. And so it's for a number of reasons, especially being youth and just the way that the country is run, India has become attractive or being highlighted by a number of wealth management intermediary firms as an attractive place to look as emerging markets might have a resurgence as global growth accelerates.
Yeah, and economic growth is there in India. I think it's like 8.4%. And without issues around inflation. Neither one of us are economists, but that's really positive as well. And they're also embracing technology overall as a culture.
Yeah, no question. And I mean, as you're familiar, I mean, the banking system, digital payments, the ability for them to just skip some of the evolutions of technology like we have. Like I don't think anybody's had a cassette or CD player in India. They probably go right to streaming, and that's a good thing for them. So, we are just big believers that consumption is a big theme. If investors are looking at the way that they want to approach India, we would just ask them to consider what is the outcome they want in their exposure. And if they want to try and tap into the growth of the Indian middle class growing and starting to use the extra pennies and dollars of discretionary income that they have, that INCO makes sense within a balanced emerging markets exposure. And as you said, right, INCO is a great complement to XCEM. So pairing them up, if you want to get a packaged exposure within emerging markets, we think they make a lot of sense.
Yeah. So we've touched on emerging markets. I think made a pretty strong case for a combination of your two funds, INCO and XCM. But let's also talk about the U.S. because you along those same lines, you also have some interesting U.S. funds that eliminate some of the, what do you want to call it?
Losers?
Yeah. Yeah. And you know what? We tend to be stubborn as investors sometimes in carrying, it'll work out eventually, the losers, right?
Mm-hmm.
But that's not really the case always, right? And further to that point, constantly reweighting what's not working hurts your returns. Talk just a little bit about the funds that you're involved with at Columbia Threadneedle.
Well, absolutely. And I'll start by saying just a few context bullets. Number one, what we're trying to do at Columbia Threadneedle is take what we're really good at, and both fundamental research and quantitative research are strengths of the firm. And we've had success with a solution called RECS, R-E-C-S. It's a research-enhanced core solution. We also have REVS, which is a research-enhanced value solution. And the punchline is that we take our quantitative research, we rebuild a popular index that you already know. In the case of RECS, R-E-C-S, we rebuild the Russell 1000. So you have the exact same sector weights as you would in the Russell 1000. But rather than using 1,000 stocks, we only use the 350 to 375 stocks that Columbia quantitatively rates as strong buy or buy. And there's a couple of backstories here that I think are worth sharing. Dan, you and I know from many years of conversations that benchmarks were never intended to be portfolios, right? They tend to take this kitchen sink approach. They were rolled out in the mid-'70s and proliferated in the '80s and '90s, really due to ERISA. I like to say and remind people that the ERISA Act of 1974, Employee Retirement Income Security Act, had a few tenets that if a company was managing your pension money, they had to do it prudently, they had to have a written investment policy, they had to do due diligence, and finally, they had to monitor performance. So benchmarks, in my opinion, were never intended to be portfolio. They take a kitchen sink approach. And, when you take a look, and if you were to utilize sell-side research to look through at something like the Russell 1000, you would find that close to 40% of the portfolio, as rated by sell-side research, could be at a hold or 6% as a sell. And so when we were sitting around in mid-2000s, 2018, 2019, the second backstory that I wanted to share was around Reg BI, or best interest for a client. And as we sat around the table at Columbia Threadneedle and said, how could we, or why would we build an index that knowingly included stocks that we had rated sell or strong sell? Why would we knowingly ask investors to invest in companies that we had rated as sell or strong sell? So we did some modeling, and that was the impetus for the creation of RECS, the Research Enhanced Core Solution. And just to be clear, we build RECS with only Columbia Threadneedle rated buy and strong buy stocks. Mm-hmm. Said another way, we leave out the holds, sells, and strong sells. And the general concept is by leaving out the losers, as I call it, you're able to, reduce portfolio drag and enhance returns. And Rex has done exactly that. It's outperformed the Russell 1000 since inception. It's outperformed by 70 basis points annualized the S&P 500. And I know you have some charts on here, and our time frames might be different, but the concept of outperformance is there. If you can leave out the losers and reduce the deadweight drag, hopefully you can provide some alpha.
No, I mean, it totally makes sense. Again, you're avoiding or you're eliminating what isn't working. It's just kind of common sense, and yet that's not always the case for a lot of the benchmarks that exist. So it's just funny how that works. So let's pivot now to fixed income so we can complete the old portfolio, right? You also have some interesting products in the way of fixed income. But talk to us a little bit about must versus MUB, if you want to be specific, or if you don't want to be specific, that's fine too.
Well, Dan, I'm going to say you're being specific, but yes, I will address
specific.
Yeah, you're being specific. I will address our solution, but I have a phrase that I've used on this and other webinars that bond benchmarks are bad. And that's the basic premise, right? Is that bond benchmarks tend to be bad because they tend to give the largest weight to the biggest issuers of debt. And your whole point with Rex is that, it makes common sense. And we think building your own bond benchmark is common sense because taking one off the shelf from a team that has never managed fixed income and is just an indexing company is a kitchen sink approach. And so what we did is we worked with Catherine Steenstra and Doug Rangel, who run our active muni solutions. And we said, how could we build a better benchmark? And when you think about fixed income, I know what all the listeners know, that in fixed income is your primary driver of return. And the challenge or the problem of a traditional national muni bond index is that it gives you a lot of exposure, typically over 50%, to state and local general obligation bonds, which tend not to give you a lot of yield. And Dan, I know you're showing this. I do have a story that I think relates to this, and investors that I've talked with face-to-face have liked it. But there is a relationship between muni bond indices and Brazilian steakhouses, specifically Brazilian rodízios, right? And when you go into a Brazilian rodízio, they're very specific about what they do and the experience that you have. And the question that I ask investors is, if you were going to a Brazilian steakhouse, would you want to fill up more on flank steak or filet? And most of the time, 99% of the time, people will say, I want more filet. But what does the Brazilian steakhouse do? They bring out flank steak loaded in a salty sauce. You eat that, you tend to drink a lot of water, and drinking more water fills you up, so you actually eat less filet. And that, if you can believe it, is the exact same concept that happens in muni bonds. Muni bond indices, traditional ones, go up on lower income producing state and local bond issues. And they don't give you as much exposure to higher yielding opportunities that you might find in healthcare, in high yield, in AMT bonds. And so what we did in working and based on the insights of our portfolio managers who manage both our active portfolios as well as our passive portfolios, we redistributed the weights within a traditional benchmark so that we gave you more exposure to more revenue bonds and more of the income producing sectors within munis rather than loading up on state and local geo bonds, just because, number one, we get a little bit more income, and income is a great base of return within fixed income. We also wanted to be differentiated, and we wanted to bring our insights from Columbia Threadneedle's active management team into our ETFs, so that when we're sitting with investors and we're going through our municipal offerings, they can choose the pricing and portfolio packaging that best works for them. So MUST has been a nice success, and as you've highlighted, the returns on a relative basis to peers have been very, very strong.
Yeah, no, and I don't mean to be picking on our friends at iShares. Don't get me wrong. It's funny how sticky some money can be, and not always looking for the best performance. So give us some tidbits around tickers. We're always trying to come up with great tickers. How did you guys come up with MUST? I mean, that's kind of like a fun ticker.
I think it stands for multi-sector muni. So MU, I think, would be for the muni, and then who knows what the ST. But as you know, right, tickers mean a lot. And when we looked at what was available, and you're trying to get an MU in there, and then MUST was available, and it allows us to say you must try MUST.
Speaking of tickers,
yeah,
let's dial up. What about
Sure.
Dial? Talk to us a little bit about Dial.
Yeah, Dial, just to set the stage, Dial stands for is taxable fixed income. It is the diversified fixed income allocation ETF. So it's meant to really give you a lot of varied exposure, multi-sector exposure in one package to make your life easier, make your statement management easier, allow you to access things like high yield and emerging market debt, but not have those types of names show up on a line item as a statement. There are times when my 80-plus-year-old parents should be owning high yield and emerging market debt, yet they probably don't want to see that on their statement. Dial, we think, is a great statement management tool to be able to give you access to multiple sectors of fixed income in a nice package that's nicely named the Diversified Fixed Income Allocation ETF. Dan, on this one, we have sort of a first to worst story, and I want to be clear with the audience, but we're very excited for the proposition of what could happen. So when we looked at the end of 2021, Dial was the number one performing multi-sector mutual fund or ETF in the country. So 5-star rated, had done very well, but why was that? Well, in part, Dial is a static portfolio allocation. You always know what you own, and it has a 6.5-year duration. It benefited from that rate cutting environment that we went through. So the number one performing multi-sector ETF or mutual fund. We all know what transpired in the last 18 months. We've had the fastest set of rate hikes that we've ever witnessed. Dial was in the last percentile. It was the 99th percentile performer. But if you think about the environment that we're going back into, if it has any look towards what we experienced in 19 and 20 and 21, it could be a little bit different. So we had a little microcosm of that, when we've had this Halloween rally, some are calling it, at the end of 2023, where November and December, we saw rates or the expectation of rates and the 10-year decline dramatically. Dial was in the 3rd percentile of all multi-sector mutual funds and ETFs. So when rates or the expectation of rates start to come down, maybe we'll hear more today about where the Fed's headed. Dial can be a winner. And again, it is managed and based by our active team, but is a passive representation of what they've learned from managing active money for a long time. It's 28 basis points, so very cost effective to get exposure to things like high yield, dollar denominated debt, investment grade corporate mortgage-backed securities, and 2 sleeves of treasury. So if you want to get a lot in one convenient package, take a look at Dial, the Diversified Fixed Income Allocation ETF.
Yeah, I think we can hope that interest rates will go down at some point. We want that to happen. So you're talking about going where the puck is headed. and taking advantage of that. So it makes a whole lot of sense. And duration matters. Almost
it does.
Structure, you know. So Jay, this has been a great conversation. Obviously, people can learn more about the funds by going to Columbia Threadneedle and reaching out to you directly. What is the best way to reach out to you directly? Is it, of course, through LinkedIn or through emails? I don't think you want to give your phone number out there, by the way.
Well, yeah, right. That who knows what would happen then. It's a little, email is great. So it's Jay dot McAndrew, MC Andrew. And then at the end, it's at columbiathreadneedle.com. So it's a little bit long on the tail, but j.mcandrew at columbiathreadneedle.com. And number one, I'd appreciate the outreach and willing to have conversations to try and help investors for whatever they're looking to do. So Dan, as always, we appreciate the time and exposure that you create and the team creates. So thanks for having us on.
Thanks very much. Be well, everybody. And you can, of course, always reach out to me directly, anybody out there, and I'll introduce you to Jay. Thanks very much, Jay. Be well, and talk to you more.
Can't wait, Dan. Thanks again. Hopefully I'm back in a year with really solid projections like I did last year.
Yeah, I hope so.
Yeah. If not sooner. Take care, Dan.
Yeah.